That works. Amazing with the microphone.
I never saw any group pay attention to Ted just like you guys did. I mean, Ted said, find your seats. Everybody got quiet. I'm like, that never has happened ever.
Why does that surprise you? Wait a minute.
No one listens to you.
Yeah, that's fair.
Let's see.
Well, on that note,
good
evening. Thanks to all of you for joining us. This, I believe, will be the largest audience we have ever had. So thank you very much. It's fun to say that every year because that's been our history. So
yeah, every year keeps getting bigger. We have outgrown like every venue in Pittsburgh except for here in the convention center. So as long as we have here in the convention center, we can keep on going.
Or outdoor in one of the stadiums.
Or we could go to...
We can go outdoor in January, February, like in one of the state football stadiums.
Yeah.
That might be fun. It's like a playoff game that we don't go to.
We appreciate everybody coming here for the 30th anniversary of Pitt Capital Group. We have trouble believing that you could trust those two guys with your money. Ted, I think Ted looks like GQ with that model, and I don't know what happened to my hair, but it went away.
Yes, for both of us. It went away.
Right. So yeah, you trusted us. It worked out. Who knew? Okay. I know it's there you go. There's the normal look.
Yeah. There we go.
How about that?
There are the two old dudes.
Woo. We're just gonna keep using those pictures for the next 30 years. It's sort of cliche to say this, but what we know is this: if you take care of your clients and you do the right thing, everything else takes care of itself. More people come, they follow their friends, they follow their family, and that's why we have over 500 people in this room. We had 80 people last week in Bonita Springs. We had 70 people the week before that in Harrisburg, and it just is a testament to all of you growing with us, sending us more business. We've got 4 generations of families now. Most firms like us measure success by how much money they manage. And that's the measuring stick in our business. And we don't do that at Fort Pitt. Our measuring stick is how many people are we helping? And we're helping now over 3,500 families. That's how many people we're helping.
As Mike said, we knew that if we took care of you first, everything else would take care of itself. So we thank you for that because there's been a lot that you had to trust, obviously, in two young folks that stepped out to start a business. And when you do that, there's a lot of risk. Oh, did you went back there? Okay.
I just love the mustache.
Just to distract. I know. It's okay. I was going to actually shave this off just to see what that would look like, but Ilsa said no. No, it's tough. When you start a company from the ground up, you take a lot of risks. You put your family at risk. You put employees at risk because they don't know whether things are going to work out, and you try to do the best you can to make the best decisions, and they count on you to make those best decisions so that the company survives. And we always just said, look, if we take care of our clients, it all takes care of itself. So I know that gets used way too often, but it's happened here, and we've built a great crew of people who have also embodied that same attitude in just making it the best experience for you that we can. We took all that stuff. We didn't take it lightly. We said, this is a serious thing. We've got to be serious about doing something and building something that lasts. I would have never imagined 30 years, but not for any other reason than we got up, put our heads down, and went to work.
We obviously appreciate the support of our employees. All of you have met so many of them that are here tonight. We've got folks here that have been with us for well over 20 years. You know who they are. But you don't do this without the support of your employees. You don't do this without the keen support of your family. I know they don't want this, but we got to recognize Beth and Ilsa. It's a lot of long hours. It's a lot of time away from home. And we could have never done this without Beth and Ilsa supporting us.
No chance we can get you guys to, no chance we can get you to stand up? No, okay. Why?
We just would like all of you, at least everybody, to come and say hi to Beth and Ilsa,
Yes,
okay?
yeah. So, and actually, because Mike and Beth have been together for 38 years?
38.
38 years? Sorry, I know you're shaking it off. So, but that's the real thing. You've been together for 38 years. For Ilsa, it just feels like 38 years. So, sorry about that, love. So if you go up and introduce yourself, it's great. For Beth, I would ask her how she did it. For Ilsa, I would ask why she did it.
All right, we're not going to take a lot of time, sorry. But we've all been through a lot together, and we just want to talk about what we've been through. And most people fret about when the market goes down next. And over 30 years, the market hasn't really gone down that many times. But there have been significant moments that have rattled all of us. So we'll start by hitting some of those milestone moments of being freaking rattled.
Over the last 30 years.
Over the last 30 years.
So the good thing was we didn't start our company in 1998. We started it in 1995 because if you remember, for those of you who've been with us long enough, in 98 we had the Russian banking debacle, we had Asian contagion, and the world thought that everything was going to go upside down when one of the largest hedge funds almost went belly up in 1998. But you stuck with us. Most of you probably don't even remember that year. But it was a tough year.
It was the one time that we actually sat around and thought about going to cash, but we didn't do it. The year 2000, Y2K, dot-com bubble burst. Fortunately, we weren't loaded up on dot-coms, telecoms, tech, Ethernet stocks. Remember, the NASDAQ went down 75%. So we lost money, the market lost money in 2000, 2001, 2002. I remember clients who started with us in 2000. So we didn't have a great story to tell. You lost money again, you lost money again, you lost money again. Hey, you hung in there. That was really tough. It paid off.
Well, it's because we lost less money.
Well, there you go.
Which is also the other side of it. So, but then we had kind of smooth sailing for a couple of years until we hit 2007, 2008. Where we had a global financial crisis. We had the housing bubble. The markets declined about 46% from top to bottom, but we got through it. You hung in there. You stayed with us. You stayed the path, and it worked out.
The theme is hanging in there, okay? Not timing the market. In 2010, we had the flash crash where, boom, 1,000-point drop in one day, 1,000 in a day. People would get a little upset about that. Charlie Smith was on the front page of USA Today. Is there still USA Today? Is it still around?
It's still around.
Okay, USA Today, Charlie Smith quoted, Pitt Capital quoted, the machines took over, but we hung in there, we got through it.
And then we had a great decade, pretty much until we got into 2018. And 2018 was pretty good for most of the year. We started to have some inflation worries in the last half, the last quarter. Markets dropped about 20% in the fourth quarter of 2018. Again, because we had a pretty good year, didn't feel as bad. Then we hit 2020, COVID. Markets dropped 35% in a month and a half and recovered all of it by August. The fastest drop, fastest recovery in stock market history, all because of something non-financial. but you hung in there. You figured out, if you didn't learn that you couldn't time then, you never figured it out.
And then most recently, 2022, the market was down over 20%. Why was that? The Fed took interest rates from 0.5% to 4.5%. That's upsetting to the markets, but you all hung in there right with us, and we made our money back over the last couple of years.
So kind of funny, we look back at where the Dow Jones was in summer of 1995 when we had this idea for a company called Pitt Capital Group. It was trading somewhere around 4,800, 45,000. Been kind of a pretty interesting run for 30 years on the compounding. So the key phrase that we have, though, is just thank you for hanging through all that, hanging in there, believing in us, trusting not just in us, but the wonderful staff, the people that we have, people you're going to hear. We couldn't have done it without you. But one of the things we thought would also be kind of fun to do, a little different. You get to work the clicker.
Yeah, I'm going to work the clicker.
Mike's going to work the clicker. We're going to show you a quick day in life at Pitt Capital very quickly, because you've already put up with more of us than we're probably allowed to speak.
Yeah.
They usually only give us a couple minutes and tell us.
Typical day, way back then, Ted is like, what's for lunch? What? We ate so much junk food. Ted's like yelling across the hall, what are we getting, Burger King or McDonald's?
Notice no mustache in this.
Yeah.
Just if you're comparing notes. Charlie says, of course, hey, markets are up. We can get a Whopper with cheese. Markets are down. It's probably just a regular hamburger. And we're like, I'm not kidding. This is every day with Charlie. He's like, yeah, I don't think the markets are having a tough day. We should not have the cheese for the extra 18 cents.
You can see that it was not a cheese day because Charlie looks very somber. And then I'm like looking at Doug Krebs going, I don't give a shit whether it's cheese or not. We want to eat lunch. So we're going back and forth. And then
wisdom prevails. Arlene says, I'm going to make the call. It's going to be Minios, it's going to be a sub, and you're going to split it. So you guys can talk for another 10 minutes if you want. I'm going to order lunch now.
Then Doug Krebs goes, I love Minios, and that was a Minios day because Arlene took over and she made the call. So that's a typical day way back then.
It's important to notice, though, that we all bought the same packet of blue shirts. So times were a little tough. Costco had a couple nice specials. You gotta embrace it. We thought about wearing those shirts tonight, but we couldn't fit in them. So
yeah. Cannot wear the Costco shirt anymore. On a serious note,
we lost one of our original partners last year. Doug Krebs passed away at age 55. Doug was more than instrumental in setting up the company, getting it started. Doug had an amazing intellect for being able to do whatever you needed. We'd have a problem, we'd all sit around and talk about it. Doug would just go fix it. He'd figure it out. Doug leaves behind a beautiful wife and 2 beautiful kids, and he will be missed.
Okay, on a brighter note, okay. He will be. He did so much. Now, on a brighter note, if you watched the slideshow, you saw that Ted has a new baby, grandbaby, grandson.
Ezekiel in October. If you see him, he's wearing the promotional Pitt Capital onesie. It's blue. It's his grandpa's favorite color. So you'll see him flashing around, but you'll also see.
You might have seen my daughter Maggie's ultrasound, and she's due in June 15th, and Beth and I are going to be grandparents for the first time. Circle of life.
All right. Yeah, the circle of life. So we have one other bittersweet It's a fantastic thing to be a part of working with someone for the last 18 years. Carrie Kelly will be retiring from Pitt Capital at the end of March. Do not ask me how I will survive this. I have no clue. Carrie has been not only someone who I've been able to trust and have been unbelievable friends with. We've been friends for over 35 years. She has been irreplaceable as someone in our office, as someone who people have counted on. Many of you know her. Carrie, wherever you are hiding. Carrie, would you just
please
stand?
up?
There
She's
she
right there.
is.
Stay stand.
Thank you from the bottom of my heart.
Ted's going to have a tough time with that one. All right. Well, that's enough of us. Okay. Bill Engel is our MC for tonight. Bill's going to take it from here.
Thank you all.
Thanks, Mike. Good job.
There's the clicker. Okay.
Good evening, everybody. Thank you, guys. I don't mean to beat a dead horse, but like when you're up here and you're looking out, it's an enormous crowd. It's so great to see everybody. I was a little worried that with the weather forecast earlier that we might not get as many people, but we did. So welcome. And for those that don't know me, again, I'm Bill Engel, one of the senior advisors here at the firm. It's my privilege to be your host this evening. If you've come to this event in the past, it's pretty much a familiar agenda. We're going to have a introduction to an outlook, a look at the markets in 2024, and then our outlook for 2025. We'll follow that with a question and answer session, and then follow with lunch. Dinner. I either had too much wine or not enough yet. But before we get started with the program, a couple of housekeeping items. First is we're very excited to offer you a gift this evening of a commemorative etched stemless wine glass. You can see the picture, I think. So we made it easy for everybody this year. Everybody gets one, regardless of whether you're here as a couple or a single. So please get that on your way out and enjoy that. It's etched with our logo and the 30-year anniversary. So very excited about that. Next item is with your registration and when you got your name tag, you should have gotten a ticket, a meal ticket that has your entree on it. You're going to present that to your server. If for some reason you didn't get it or it's incorrect, you can flag a Pitt Capital employee and they'll help you with that. Next, on each table, there is a beautiful centerpiece, compliments of Fragile Paradise, and these are meant to be taken home. In the past, I've suggested different methods for determining who gets to take it home. I've been yelled at and shot down, so I'll just say you can do rock, paper, scissors, you can arm wrestle. I just ask that if you arm wrestle, you let me know because I want to watch. But just make sure that there aren't any left on the tables. They're meant to be enjoyed, and please do so. Parking. If you parked in the Gateway Center garage across the street, and you should have maybe already gotten a validation ticket, validation sticker. If you didn't, make sure that you get one on your way out. If for some reason you plan to stay overnight and you parked in that garage, you're going to need to move your car. They can't accommodate overnight parking. And finally, last but not least, we are going to be able to give away 2 complimentary gift certificates for an overnight stay with valet parking here at the beautiful Wyndham Grand. We're going to pick the names randomly from attendees. You'll get an email or a phone call if you are the lucky winner. Just ask that if you, it's good for a year from tonight. So if you know that you aren't going to be able to take advantage of that, please let us know so we can get it to somebody that can. Otherwise, enjoy that nice treat. So enough of me. Let's get going with the program. So we're going to hear from our Chief Investment Officer, Dan I. He's going to talk about what happened in the markets, what we think is going on, and our outlook for 2025. So please help me welcome Dan I.
All right. Hello. Welcome, everybody. It's good to see everybody tonight. You're going to get off easy tonight. I've only got 632 slides this year, so I really worked hard on trimming it down. I'm going to get the tough part out of the way up front. So while portfolios produced strong returns last year, and that's the important part, our early year outlook or forecast admittedly wasn't very good. We called for a flattish return environment for last year after a very, very strong 2023. That forecast proved to be, way too conservative, with the S&P actually up 23% in price return. So we'll talk about some of the things that we got wrong or that we missed. But I think really just to summarize, our estimate for earnings from S&P 500 companies was pretty accurate. We were only about 1% too low, but we dramatically underestimated how much investors would be willing to pay for those earnings. We thought that a PE ratio, price to earnings ratio, or a valuation of 20 times would be really the upper limit that investors would be willing to pay. The S&P closed out last year trading at 25 times the earnings that were generated in 2024. So at the bottom here, I list some of the drivers or contributors to the really strong outcome last year. I'll just walk through a few of these. First, economic growth or GDP growth. Here we show quarterly GDP really going back to March of 2022. And we really picked that date because, as Mike mentioned, that's the point where the Federal Reserve started to raise interest rates from basically zero all the way above 5% in a very short period of time. In fact, it went down as the most aggressive hiking cycle in more than 40 years. But really defying, economists' forecast and expectations, growth has really held up well. In fact, we exited 2024 with GDP growth still above 2%, still above the long-term trend level for a mature, developed economy like ours, so impressive. Also, a lot of attention to the 57 new all-time highs that were made in the market last year. But that strong market performance was really well supported by corporate profits, which also moved to all-time highs. So I touched on this point last year, but I think these dynamics are really still at play, so I figured I'd spend a couple minutes here as well. We often get the question of, how have things held up so well over the last 2 years? And by things, I would point to economic growth, corporate profits, consumer spending. And I think the real answer to that question is simply that our economy is less interest rate sensitive today than it has been in years past. And I think this chart does a good job of really illustrating my point here. So the line in the dark green at the top shows that mortgage rates are above 7%, and that's a problem. That's a challenge for those that want to or need to buy a home. But it's not a problem for those homeowners that already have 30-year mortgages locked in at very low 3 to 4% interest rates. They've been very well insulated from higher interest rates, and about 85 to 90% of homeowners fit in this envious category of having very low rates locked in for a long period of time. The same positive situation or picture with corporations that borrowed massive amounts of capital during the pandemic at rock bottom interest rates, and then had multiple years of record profits. So a lot of companies are in the situation where they have, more cash on the balance sheet than they have debt outstanding. And they're earning higher rates of return on that cash than they're paying on the bonds that they issued, 3 or 4 years ago. So what we're showing here really kind of ties everything together. So even with interest rates at the highest level in 20 years, corporations' net interest payments in relation to their operating profits are at the lowest level since the mid-1960s. Really surprising statistic. So we've also had, excessive or high levels of government spending really help to support and stimulate the economy. So on our slide here, we're showing just the dramatic ramp up in construction spending in the U.S. that's really being driven by government-sponsored programs like the CHIPS Act, the Infrastructure Act, or the quote-unquote Inflation Reduction Act. I think a good question would be, well, isn't there another side of the coin to this? Isn't there some repercussions? And I think yes, and maybe we're seeing some of that now. But if we look back over the last couple of years, I think you have to put elevated levels of government spending in the category that has supported the economy. So I know there's a lot of interest in the overall AI or artificial intelligence theme or narrative in general. I imagine we'll have some questions there tonight. But a tremendous amount of AI spending out there. Here we take a look at the capital spending on AI infrastructure, so high-powered semiconductors, servers, and data centers from just the 5 largest cloud companies, so the Microsofts, Amazons, and Googles of the world. That approached $200 billion last year, which was up 50% or more from 2023, and we can see the very positive expectations for continued growth in this space. So I think this outcome was very beneficial and supportive to the bullish AI narrative and really helped to propel the mega cap tech stocks and the AI-related stocks higher last year. So not only was 2024 just a good year in terms of returns, but we also had very low levels of volatility. The biggest decline that we had all year was about a 7 or 8% decline in the late summer months, and that's about half of what we typically see in an average year if we look back over the last 50 years. And I think this chart really kind of helps to frame why we've been in a low volatility environment. We have almost $7 trillion out there right now in money market funds. And I'm certainly not making the case that all of that cash is earmarked for equity markets, but I think it does help to explain why when we do see periodic declines or dips in the market, in the equity market, we also see buyers show up in pretty rapid fashion in order to take advantage of those lower stock prices. And given where liquidity levels are now, we think this could be a supportive outcome for 2025 as well. So here we look back to 2023, which was also a phenomenal year for equity markets. S&P up 23%. Really just showing this because I think it kind of helps to explain to some degree why we had fairly tempered expectations for 2024. We thought that a lot of the positive outcomes that we realized last year were actually priced into markets to some degree back in 2023. So we think by the spring, investors had kind of figured out that the Fed was just about done raising interest rates. And by the fall, it kind of sniffed out that the Fed's next move would be, an interest rate cut at some point in the near future. And throughout the year, that investors really replaced the expectations for a hard economic landing with a soft economic landing. But, those outcomes were obviously celebrated once again in 2024, and we will certainly take that outcome. Turning our attention to the outlook for this year, obviously we start the year off with a new administration, a new set of policy agendas. I think that, tariffs are probably at the top of the list of investors' worries or concerns. I saw this chart from the Peterson Institute that I thought was pretty interesting, and I figured I would share it. And here they take a look at the outcome from really two variables, right? So they assume, very severe across-the-board tariffs and the negative impact to the consumer or a broad range of income cohorts, and that's reflected in the orange bars at the bottom. But also the positive impact to the consumer from the extension of the 2017 tax cuts, which we think is a very high probability, type of outcome. And I think it's interesting. They show the net effect of those two outcomes in the green bar. Based on their work, there would actually be a small net positive for the top 1% of income earners, and only a very small, let's call it 1%, hit to the top 20%. I'd say there's also a number of policy agendas that are much more difficult to really pencil out on paper to show in a chart. Things like, deregulation, an increase in confidence from business leaders, and at least the possibility that we see a reduction in corporate taxes. So we don't know how policy is going to translate throughout the year, but it's something that we'll be watching very closely. One thing that we do know is that we have very strong expectations for corporate earnings growth this year, which we think is a big positive. If we look at the center of the chart here, we can see that analysts are penciling in expectations for almost 15% earnings growth from S&P 500 companies. The other bars show expectations for specific sectors, pretty broad expectations across all market sectors. We think it's a big positive. But the real reason I wanted to show this chart is because we certainly do expect to have some headwinds and some challenges that we'll have to grapple with throughout this year, no different than any other year. But I'd much rather be dealing with that in an environment where we do expect strong and supportive earnings growth. Okay, here we take a look at inflation. So I think it's interesting. We didn't really talk about inflation as investors as much last year as we did in the previous 2 years. And I think that's really because for most of the year, inflation was on this, pretty comfortable downward trajectory. I think it got investors and the Federal Reserve really comfortable with the idea that inflation would soon return to their long-term 2% inflation target. In fact, the Fed was so comfortable with this outcome that they decided to move forward with I'll call it a jumbo interest rate cut in September of 50 basis points, and they managed to squeeze in 2 more interest rate cuts before the end of the year. So let's take a look on the next slide and see how the bond market reacted to the Fed's decision. Just to summarize, not well. So traditionally throughout history, when we see the Federal Reserve lower short-term interest rates, long-term interest rates have declined as well. That certainly hasn't happened this time. In fact, we've seen the exact opposite reaction. So on the chart here, we're showing the movement in the 10-year Treasury bond yield from the day that the Fed started to raise interest rates throughout the end of the year. And we can see the dramatic spike. And we think this is the bond market sending a very clear message that it's not comfortable with the Federal Reserve cutting interest rates aggressively when the inflation situation hasn't been solved, when economic growth is still above trend levels or long-term trend levels, and when we're still at, or at least very near, full employment. So we really think that the key, variable for this year is developments in the bond market and on the inflation front. So I think this is kind of the other side of the coin chart, right? I mentioned that repercussions from excess government spending. we're rapidly approaching the point where the annual interest expense on our debt is closing in on $1 trillion a year, which is well above our annual defense budget. So we think it's going to be, pretty difficult, pretty challenging to get interest rates back down to, more comfortable levels unless we see some restraint on the fiscal front from the government. And this is usually where somebody jumps in and says, good luck with that. Okay, so as I mentioned, we've had 2 back-to-back, phenomenal years. It's been absolutely great, but the result has been, high valuations. And that's certainly not a statement that we believe that all stocks in the market are expensive. That's certainly not the case. But at least at the index level, valuations are elevated compared to history. And what we're trying to show and kind of triangulate on our chart here is the starting point is high valuations, future or forward returns have at least historically been, lower than long-term historical averages. So wrapping things up here, when we've looked back through history and we've started with a valuation multiple of around, 22, kind of in line with where we are now, forward returns after adjusting for inflation have been in the low single-digit range, which we'll use 3.5% as a proxy there. Instead of trying to be geniuses and predict what inflation is going to be there, we'll use the Federal Reserve's estimate for 2025 at 2.5%. So we put those two numbers together, works out to a 6% type of return for the S&P, which would leave us at 6250 at the end of the year. So we think that's a kind of a good baseline estimate that balances, a lot of the positives that we see out there with some of the unknowns, uncertainties, and negative potential outcomes. So with that said, let's hope we are way too conservative and we have another year of great returns for the market. I'll turn it over to Bill for Q&A here.
Thanks very much, Dan. I think that's all very valuable insight and gives folks a sense of the kinds of things that you look at and guides our decision making. So next we're going to start the Q&A session. I'm going to welcome our head of asset management, Jay Samariva, to the stage. Thank you to everybody who sent in questions. We pretty much compiled the most frequently asked ones, and Jay and Dan will answer those. We'll start with the big one. It is, what is your view on interest rates and the bond market for this year? Jay, we'll give that to you.
Yep, I'll take this one. Real quick, though, I want to revert back to one of the slides earlier. I just want to make some comments on this one. I don't think we put enough time into this. And as an analyst, I think we need to look at this a little further. So you have Mike on the left, and then you have Ted on the right. This is a prime example of early peaking and late peaking. Mike, love you like a brother. You look a little homely there. But you have, look at him now. Look at this cat.
It's a real glow up, they call it these days.
Yeah, great looking guy. On the other hand, this guy looks, it looks like Kevin Costner. Am I wrong? Seriously. Great looking guy. Kinda went the other way. Not much, just a tad. Just a tad. But, seriously though, these guys are awesome. Everybody at the firm loves these guys, and obviously nobody would be here without them, and we really appreciate it, so thank you. All right, the fun stuff. Interest rates, is that the question?
Interest rates and bond markets for the year.
Yeah, I mean, Dan touched on it, obviously, and a lot of it is going to be predicated on what the Fed's outlook is going forward, and even more important to that, how much interest that we're going to be paying on our debt. So Dan had a great slide that showed how the Fed lowering rates by 100 basis points and the 10-year going up by 100 basis points. I don't think people can really grasp how extraordinary that is. It's never happened before, never. So the market is telling us that you may have been a little, jumped the gun a little bit when you were reducing rates, because we haven't seen the inflation fall to a point that would necessitate any more. So with that being said, we're only seeing the probability of the Fed funds futures going forward of one more ease, and that's towards the end of 2025. So, if we continue to get the economic numbers that we have seen, that number may shrink down to, closer to zero. So we could have seen the majority of the eases, if not all of them. But again, it's going to be predicated on all of the data that we see. Interesting enough, we have the labor numbers coming out tomorrow. And this will be the first time that the new census has taken effect. So we're going to see 3.5 million more individuals in those numbers tomorrow that we haven't seen before. So that in itself should tell you that the unemployment number should go up, just because they're including more people in those figures. So it may be a little jumpy tomorrow, around 8:30 when we get these numbers, but I think once it all gets smoothed out, everybody will be able to understand what's going on going forward. But tomorrow is a big day when it comes to that. The bond market going forward, if you're a saver, this is the best time that you've seen in the last decade. You're seeing just on your money markets overnight upwards, 4.5% even now on just the cash laying around. So that's definitely a great sign. And if you want to go out further in the curve, you're also seeing the opportunity to, buy a 5 to 10-year instrument, even a treasury above 4.5%. So if you're in that market, it's considering where we've been for the last 10 years, it's not a bad place to be to park some cash. But again, like Dan said, over time, equities are going to outperform that. It's just a matter of how much stomach you have to, take the ups and downs. And as Mike and Ted expressed at the beginning, if you've had that ability, you've done very well. That's kind of where we're at on the interest rates in the bond market. I think we're at a good equilibrium right now, to tell you the truth. 4.25 to 4.5 on the Fed funds rate is probably right. And if we can, I think we'd be much better off to stay there for a while instead of just automatically, okay, we're going to go lower, because then it'll give the equity markets an opportunity to digest that interest rate and to make decisions based upon that interest rate. Historically speaking, the majority of the people in this room have seen interest rates a lot higher than that. I think we're doing a good job of trying to figure out where this is going to go in 2025. And as far as our investment strategy in 2025, we continue to buy out the curve in good names and to try to lock in some of that interest rate at this point.
All right. Thanks, Jay. Dan, I think this one's for you. What are the key drivers and risk factors that you're watching that could affect the stock market in 2025?
Yeah, it's a good question. I think at the high level, we think that economy generally hangs in there. really the same picture with the labor market. I mentioned, our positive expectations for earnings growth this year, which I think is huge. I think it really does tie back to, interest rates and some of the things that Jay was talking about. If we look back over the last, I'd say, year and a half, we've kind of been in this range on interest rates. If we look at a 10-year Treasury as our benchmark, from being 3.6 or so on the low end up to 4.75 or so at the high end. And I think the market's generally fairly comfortable with that range. But if we do see a move above the upper end of that range, I think that could get the equity markets pretty uncomfortable in a pretty short period of time. So I think we're certainly keeping our eye closely on inflation, as I mentioned, on this good downward trajectory through about September of last year. And then we have seen inflation progress start to level off and seen some slightly higher prints. So I think from the equity side of the standpoint, we don't want to see bond yields get out of control, take out that higher end of the range. So I think that's really kind of the key risks that we're watching right now.
Great. Probably each of you could give some insight into this, but you alluded to it in your presentation, Dan. Big theme that a lot of people are talking about is AI. So how do we view AI in general, and what role do you see it playing with Fort Pitt?
Yeah, I'll grab that one, Bill. So we think it's real. We think it's a transformative technology, no doubt about it. Every time that we see an estimate out there on how much these large cloud companies are spending to build out their infrastructure, a month later that estimate it looks to be way too low. But we also think that it needs to evolve over time. If this is going to be the most transformative technology that we've ever seen, we can't see all the benefits just accrue to a handful of companies that make the semiconductor chips. It's going to have to be much broader than that. The customers that are purchasing this inventory, they need to earn a rate of return on that investment, and in fact, a very high rate of return on that investment. And we think the only way they do that is if the technology gets adopted in a much broader fashion. So we need to see, companies like banks, use AI technology to help grow their loan volume. We need to see companies like pharmaceuticals shorten the time it takes them to bring drugs to market. We need to see more evidence that companies are, monetizing the technology. And I think the big benefit there is we certainly saw more proof of that last year. We saw more use cases and monetization than we did in 2023. And we certainly think we're going to see more adoption and monetization here in 2025 as well.
Great, thank you. This next question is pretty timely for this week. How will proposed tariffs affect the market, and how should we position ourselves in light of the tariffs? I guess you can answer with some hindsight now, but what do you think?
Yeah. The tariff question is obviously has come up quite often. And the more that we look into this, the more we see, that the majority of this was planned for. I mean, there's no mistake that, or no question that this has been floated out in the last 6 to 9 months of something that was going to happen. And if you look at, I was telling in our IPC last week, I was looking at the tariffs that, we're talking about Canada, Mexico, and China in particular. So the three countries that have the largest tariffs on the United States prior to any of this happening were Canada, Mexico, and China, in that order. Some of the tariffs that come from Canada on U.S. products are in excess of 200%. 280% on milk, 200+% on dairy. On meat, it's almost 200%. So they're very high. And for the United States to say, hey, listen, we want to kind of even this out a little bit, to put 25% on, it shouldn't be a call for the end of the world. A lot of these companies have already positioned themselves for this. There's things that they could do in the currency markets, which they have done, and the odds of this happening are going to be slim to none. And let me tell you why. Over 50% of Canada, which I believe it's closer to 80, of their exports come about, let's just say 50. It's closer to 80, but I just want to be even here. 50% of both Canada and Mexico's exports come to the United States. 1.2% of American products go to those countries. If the United States wanted to, they could basically put both of those countries into a depression by the 4th of July. So it's not going to happen, and there's no reason for that to happen. There's just some things that have to happen in order for those tariffs to go back down. China's a whole different story. I think everybody knows the issues that have been happening with China, especially COVID that really brought everything to light when we couldn't get the ingredients for medicine. We couldn't even get masks. I mean, that's our fault. It's not China's fault. But I think it brought a lot of light onto, hey, maybe we should make some of this stuff, maybe we should make some of this stuff at home. As far as how it's going to affect the market and how we're going to position for it, obviously it's not good. The market hates when things are not certain. So as you saw a couple weeks ago, even when this was floated out, the market got a little bit jittery and fell off a little bit, and then cooler heads prevailed, and we were able to sort of stall that. So I don't think it's going to end up panning out that way, but if it does, I think the market will react accordingly and reevaluate where they're positioned going forward. And like I said, they've already done a lot of things to do this, so I don't believe in my mind that it's going to be that big of a hit to the markets.
All right, thanks, Jay. So the last question, as you all know and should know, back in November we announced a merger, and a lot of people asked questions about how that merger is going to affect us or enhance our investment process. So any insights on that?
Sure. I'd say, as you mentioned, Bill, this all wrapped up in November, so it's been 3 months. I'd say from my seat, there's an equity team out in Chicago, a deep team, well experienced. So we've been starting to work with that team, and I think anytime that happens, I think the real big question is, do you share a similar investment philosophy? And I can say really confidently that yes, we certainly do. I'd say another big benefit is I've been through a number of mergers, and I think big egos can sometimes get in the way of success. And again, I can say confidently that there's no issues on either side there. So we've started to share investment ideas, which I think has been really helpful. So I think at the end of the day, for clients, we're going to have more smart people with more ideas, and that should translate into good outcomes.
Great. Jay, any insight? Or good? Great. Well, folks, that's the end of our program. We really appreciate your attention and your interest, and we're very, very grateful that you decided to join us here tonight. So please enjoy your meal. The salad should be coming out soon, and we look forward to socializing with you for the rest of the evening.